Good day, grade 9s. For term 3, week 1, you are required to complete activity 27 and activity 32. So I'm going to be explaining these two activities before you go ahead to complete. So activity 27 says complete the transaction in the table below to show the impact on the accounting equation. Now, very important, I need you to remember the accounting equation and the golden rule that I told you about. Those 3 questions. What is happening to bank? If it's a cash transaction. And remember, in grade 9, you are dealing with credit transactions as well. So if it's not a cash transaction, which would affect bank, then you must ask yourself, what is then happening to creditors, not to creditors, to debtors control. If you sold on credit, to debtors control. And if you bought on credit, it would be the very opposite, what is happening to creditors control. But in activity 27, we're only dealing with cash transactions and the business selling on credit. All right. Then there's a few more pointers. If you are dealing with cash, you're asking yourself what is happening to bank. If you are dealing with the debtors control, you're asking yourself what is happening to debtors control. Obviously, that is a credit sale. Is it increasing or decreasing? All right. If it's increasing, you're asking yourself, where does the money come from? If it's decreasing, where did the money go to? All right. Please remember that. Then I want to draw your attention to page number 74, which is the page before activity 27. They give you an explanation of how to post the credit sale transaction. So they say when the debtor pays his account. So when a debtor pays the account, meaning the person who owes the business money, when he pays, what is happening? They're actually giving us money. So our bank is increasing. All right. They're giving us cash. Bank is increasing. And remember, bank is an asset. All right. So what happens when an asset increases? We put it on the debit side. So that will be our account debit. And then what is going to decrease? Debtors control. Debtors control is an asset. So what is happening? An asset is increasing and decreasing. All right. When the debtor pays us money, the money comes into the bank account, which increases assets on the debit side. In return, we're losing that debtor. He no longer owes us money, and therefore that will be our account credit because debtors control decreases. All right. Moving on to the next explanation. When the debtor returns goods that were not damaged, he or she was overcharged on the invoice. So there's 2 things that they've got for us there. Let me just go to the next page. They say when a debtor returns goods, all right, when a debtor returns goods, or if the business has overcharged the person, we overcharged, what happens? So there's 4 things that will happen. All right. Debtors allowances. So let's first look at the first one. What will happen when a debtor returns goods? You will say that debtor's allowances will be debited. Why is this going to be debited? Because it is an expense. All right. And what do I do with expenses? I debit expenses. What is going to be your account credit? Debtors control. So let me explain this to you. When we sell goods on credit, we gain a debtor. All right. And a debtor is an asset. It's an asset to the business. Assets increase on the debit side and they decrease on the credit side. So because he's returning goods, he no longer owes us that money. So he is going to be decreasing on the credit side. Debtors allowances, we would have made the sale, which would have been an income, but because he's returning the goods back, it becomes an expense to us. We're losing out on money, and that is why we are debiting that. Are we done with this? No, we are not. What is the debtor returning? He's returning goods, which is known as trading inventory. And trading inventory to a business is also an asset. So what is happening to our trading inventory account when a debtor brings back goods that they purchased on credit? It's going to increase. So initially what happened is, this is the business and this is the customer. So the customer is not happy with the goods that we sold, so he returned the goods. So here's the inventory. Let's say the inventory was sweets. Okay, he's not happy because the packet is broken. It's let's just say the packet, well, not the packet, let's say it wasn't the correct flavor. So what is he going to do? He's going to bring back the sweets to the business. All right. Initially, when we sold it, he took our trading inventory, resulting in our trading inventory decreasing. But because he is returning it, it means our inventory is going to increase once again. I hope that makes sense to you. Alright, so what is happening to inventory? Your inventory will increase on the debit side. And then your fourth and last transaction when you are dealing with return goods in the accounting equation as well as your general ledger is cost of sales. Your expense, cost of sales, will be reversed. And remember, cost of sales to a business is an expense, but because of the reversal transaction, we will put it on the credit transaction. So it's an expense that is not increasing, but an expense that is decreasing on your credit side. I hope that makes sense to you. I'm just going to do a little illustration for you once again. B stands for business. C stands for the customer. We are selling sweets. So the customer comes to our business. The customer comes to our business and they purchase goods on credit. That will tell us that our debtors control will increase. We are gaining a debtor. Okay, and obviously what's happening, you are making a sale, so you're going to have debtors control that's increasing, and you're making a sale, which is an income to the business. All right. Eventually, the customer will then pay the business's money back. But in the event that the customer is not happy with the inventory that the business sold to them, they can return back the goods, which is this illustration that we've got on the top. So what's going to happen? Here's the sweets. The customer is returning the inventory. When a customer returns, we enter it into the DAJ, and that's known as debtors allowances. Debtors allowances is an expense to the business, and what do we do with the expenses? We debit expenses. So that will be my account debit. What is happening now? We are losing this person as a customer. He no longer owes us. So debtors control will be decreasing because he returned goods. And debtors control is an asset, and it decreases on your credit side. So you'll put it on, that will be your account credit. Then your third and fourth account is what is happening to this trading inventory that this customer just brought back, the sweets. It's returning back to the business. So trading inventory, we know, is an asset. And when we purchase in trading inventory, it increases on our debit side, right? But also when a customer returns inventory, it will again increase on the debit side. All right. And the contra account of trading inventory is cost of sales. Cost of sales is an expense to the business, but because we didn't actually make the sale happen, it will be credited. So there's going to be a reversal of trading stock. Instead of it being debited like it should be, it will be credited. Cost of sales on your credit side. All right. And the very same thing will happen to if we have overcharged the debtor. The very same transaction will take place. All right. So let's move on to the activity. I will do the first one with you, and then you will continue with the rest of the activity. I'll do 1 and 2, and you can do 3 to 5. So the total of the debtors allowances journal shows inventory to the value of 10,000 was returned and no damaged inventory was returned. The business maintains a profit of 200%. Okay, so remember, ladies and gentlemen, selling price and cost of sales is totally different figures. So the first transaction that we're jotting down is the sale transaction. So what is happening when a debtor returns goods? It's debtors allowances. That's our expense. So I'm writing here debtors allowances. Let me just decrease my pen size. Debtors allowances. And then what is happening to the debtor? Do they owe us money? No, they don't, because they returned what they took on credit. So this will be debtors control. Debtors control. Please note that you need to fix this error. Owner's equity decreases on your debit side and it increases on your credit side. So we're gonna put in our numbers. So the how much was the goods worth that this person brought back? It was 10,000. So debtors control is gonna decrease by 10,000, and remember debtors allowances is an expense, so it will decrease at owner's equity as well. Now remember this person has brought back trading inventory. So what is happening to my trading inventory now? My trading inventory is an asset account. It's going to increase. And then cost of sales is going to be reversed like that on your credit side. So this is what we are doing. We have to work out what is the cost of sales. They gave us the profit markup. So let's go to our calculator. $10,000 and the markup is 200, so we're working out cost of sales. Remember your formula for cost of sales equals selling price times 100 over 100 plus the markup. So times 100 divided by 300, because it was 100 plus the markup of 200, so our cost of sales is going to be 3,333. Alright, so trading inventory is going to be coming back into the business. Please round off to the nearest rand. And then there's going to be a reversal of cost of sales. It's instead of it being debited now, it will be credited, because we never made that sale. It came back. Your second one, they told us a credit customer returned damaging trading inventory to the value of 8,500 rand. So I just need to let you know that when trading inventory is damaged, we will not record it into trading inventory. So we don't have to work out the cost of sales. So what's happening? All we say is debtors allowances, because they brought back goods, that's the expense. Debtors allowances, what's happening to debtors control? They told us it's a credit customer, so we're losing out on a debtor. He doesn't owe us as much anymore if he still has outstanding credit. So what's happening now? It was worth 8,500. In my assets are going to decrease by 8,500 because I lost this debtor. And debtors allowances is an expense to the business. What do I do with expenses? Expenses decrease owner's equity, so it will be on the credit side, 8,100 rand. Please complete the rest of the activity. I'm moving on to activity 32. For activity 32, you are required to record the appropriate transactions directly into the debtors and creditors ledger. Now I need you to understand that even underlined it for us, appropriate, because if you go through these transactions, you will see that we have cash and credit transactions. All right, grade 9s. So let's read through it. Select Plants is a nursery that is owned by Miss Mimi Marias. Mimi started the business by depositing 260,000 into the business's bank account as a capital contribution. The bookkeeper has already recorded all the transactions for June 2019, but a fire destroyed part of the offices. The debtors journal, debtors allowances journal, creditors journal, creditors allowances journal, cash receipts journal, and cash payments journal were destroyed in the fire. So basically all the journals was destroyed. Fortunately, the source documents were not destroyed, as the bookkeeper took them home. Unfortunately, he has fallen ill and now you have been asked to help. So again, you need to record the appropriate transactions into the debtors and creditors ledger. What is the difference between a debtor and a creditor? A debtor is someone who owes the business money, so you sold to them on credit. And a creditor is someone who the business owes money to and we bought on credit. Alright, so whenever we bought on credit, know that you are dealing with your creditors. Whenever you sold on credit, know that you are working with your debtors. Very important information that you will need to take into account for your debtors ledgers that you have over here is the debtors list and your creditors list. Remember, the first line will be account rendered. Please refer back to last term's notes. So like let's do Fani Fourie. He's a debtor. So Fani Fourie, how much did he owe us in the beginning of the month? 9,200. I place it in the balance and that's going to be account rendered. The 1st of June. And then I'll go through the transactions and see where Fani took more on credit or where he actually paid his credit. If he took more on credit, sorry, we're in the creditors ledger over here. But it's the same thing. Plant World, 11,352. Account rendered 1st of June 2019. So I'm going to go through the transactions, and wherever Plant World paid, wherever the business paid Plant World, we will either record it on the debit side or the credit side. Please note that a creditor is a liability account. Every time the business takes on credit, it will increase on your credit side, hence the plus sign. Every time we pay our credit, it will decrease on my debit side. For example, if I take more goods on credit from Plant World, I'll say invoice and the number, and I'll put 300 over here. Then I'll update it by update my balance by saying now 11,352 rand plus 300 is going to be 11,652 rand. If I then pay my credit either by EFT, it will be a bank statement. If it's cash, it will be receipts. My liability is decreasing. Let's say I paid 300, then it will go right back to, I'm going to say 11,652, subtract 300, it will go right back to 11,352. All right, and that is how you'll go through the transactions. Please look out for tricks that will confuse you, so please read to understand. All right, there is something I want to bring to your attention. If it will make it easier for you, I suggest that you highlight all the credit sale transactions in a different color and all credit purchases in a different color, just to differentiate between credit sales and credit purchases. Then number 8, you will see they say a credit invoice of 1,450 was issued to Fani Fourie for 5 trees. Those 5 trees were worth 1,450, and you will see that on the Fani returns, one of the trees he bought on the 8th because his wife was not happy. So what is going to happen is, in your debtors, Fani is most probably a debtor. Yes, a debtor. So in your debtors ledger, it's obviously going to decrease on the credit side. But how are you going to know what is 1 tree's worth? You are going to take this 1,450 and divide it by 5 in order to get what is 1 tree's worth. And then you'll put it in the relevant debtors ledger on the relevant section, either debit or credit. Remember, liabilities increase on the credit side and decrease on your debit side. There's a mistake in your debtors ledger. It shouldn't be minus. Debtors is an asset to the business, therefore it increases on the debit side and decreases on your credit side. So please just fix that mistake. And that is all. Grade 9s, if you have any questions or queries, please feel free to contact me on my email address, svanross@lasalle.co.za. Thank you.